Hey everybody, Signet here with the Bullish Bears. Today we're going to finish up the video that I started the other day, uh, an introduction to calendars and verticals. All right, this is just the basics. This is just a beginner level, kind of getting a broad view. It's a way to transition into and towards the more advanced level material that we have here at the Bullish Bears website. So what we're going to be talking about: time decay, theta, building calendar spreads, analysis of those spreads, max loss, salvage value. Remember though that this video, it's not a how-to on trading a calendar. It is not a calendar strategy video. This is just an introduction to calendar spreads and a way to begin the discussion of using time value in our trading. And this kind of continues the discussion from credit spreads, which we also use time value. In options, we have a lot of ways to make money which do not involve price actually moving anywhere. We can trade theta and we can trade volatility. Calendars are a way to perform target practice, but they are also a way to trade volatility and a way to trade premium. Lots of different ways to make money with a calendar spread. We're also going to talk about losing a trade with a calendar, what break even, max profit, max value, and understanding the value in calendars. So with time decay, this brings us to theta. Options have time value, and understanding the edge that comes from time value is critical when it comes to trading options. So understand that this discussion on calendars is only going to touch upon theta and time decay. You need to go to the theta videos for a real solid learning lesson on theta. Theta is how we measure time decay in options. It's how we keep track of the extrinsic value in the option. The mathematical formula for options time decay is the square root of time. Now understand, it does not need to become some complex situation. We just need to recognize that options lose value from time decay and that we can actually measure that decay. When we buy an individual option, we are slowly losing money from time decay. And when we sell an option, we are slowly making money as the value in the option we sold decays, right? Because if we sell something, we have to buy it back. And if it decays in value and we buy it back cheaper, then we make money, right? Time decay. Options decay at the square root of time. I know how complex that might sound. It does not have to be complex. When looking to take advantage of time decay, recognize that selling premium for 1 month is going to generate far less profits than selling premium for 1 week at a time 4 times. All right, there are 4 weeks in an option, or four weeks in a month. If I sold a 1 month option for $2, it has 4 weeks in it, but if I'm just selling a 1 month option for $2, the most I can make is $2. All right, but if I sell a 1 week option for $1 and the next week I sell a 1 week option for $1 and the next week I sell a 1 week option for $1, by the end of 4 weeks I would have sold 4 different options for $1 each. I would have had the potential to make up to $4. Same amount of time, but since I was selling week to week, making $1 for each one of those weeks, I made far more value than just going out and selling a 1 month option. Hopefully this makes sense. You can sell options for 1 month out and have the potential to make that $2, but you can sell options for 1 week for $1. Whoa, we're flipping all over the place here. If you sold a 1 week option each week, you would have the opportunity to make $1 4 times in a month. Right? That's what I really want you to see out of this. You don't need this square root formula. You just need to recognize that there is such a formula and that we actually can measure the decay of time. We don't need to do that though. So this is a really great graph of theta decay. Now you got to understand that if you're looking at equity products that deal with earnings announcements, it won't even look like this, right? But what most people fail to realize is that theta decay, it's not linear. All right, so now that we have reviewed theta, let's put that theory into practice and discuss how we can use this decay to our advantage. If we trade two options at the same time, making an option spread, and we use two different expiration cycles, then the two options we have traded will decay at different rates. By selling the closest expiration option and buying the farther out option, we would then be in a trade where we make money from the accelerated time decay of the closest expiring option faster than we would lose money from the farther out option. Now, hopefully I didn't lose you there, but look at this graph and think about this for a minute. At 120 days out, the time decay has the least amount of impact. At 90 days out, the decay from 90 days to 60 days, it's slightly greater. The time decay from 60 to 30 days, it's greater still. And then the time decay under 30 days prior to expiration, it's the most rapid time frame in theta decay. It will decay very rapidly at this point. All right? And so if I have one option that is 60 days out and I have another option that is 90 days out, the 60-day option is going to decay faster than the 90-day option. So building a calendar. Calendar spreads is the simultaneous purchase and sell of an equal number of options of the same series. Calls with calls, puts with puts, on the same stock, at the same strike price, with different expiration dates. When we build a calendar, we want to buy a calendar. We sell the closest expiration and we buy the farther out expiration. And that it doesn't change if you're dealing with puts or with calls. You want to sell the closest expiration and buy the farther out expiration. If you get these in reverse, you are not building the calendar correctly. A lot of your brokerages won't let you do that unless you have a large amount of capital, because what it will look like in your brokerage when you try to do this in the reverse order is it will look like you're trying to sell a naked option. And at that point, they're going to assess how much value you have in your account and determine whether you could cover the naked sell of that option. All right, so we always want to trade the calendar this way by selling the closest expiration and buying the farther out expiration. So calendar strikes. I got a picture here showing the June 19 and the June 24 277 strikes. And in this example, we would sell the June 19 and we would buy the June 24. In this example, we are selling the June 19 call option and buying the June 24. Notice that the strikes are the same, the 277 call strikes. Remember that when we sell an option to open a trade, we need to buy it back to close the trade. If we buy it back cheaper than we sold it, we make a profit. Since the closest expiration strikes will decay faster than the farther out strikes, we will make more money from the option we sold than from the option we bought. Even though we are selling premium in this trade, we actually enter the trade as a debit spread. Don't let this throw you off, and this is where so many people get confused when it comes to calendars. It's a premium trade. We're selling premium, and yet it's not a credit spread, it's a debit spread. And then they get very confused when they're trying to figure out, well, how do I actually make money in this calendar? Well, if you think about it, if you buy it, then you have to sell it back to the marketplace to close it, right? So Forget about the idea of selling premium and being a premium seller, and forget the idea that this is a premium trade. Think about the idea that I'm going to buy a spread, and to exit, I need to sell it back to the market. Well, if I build this trade with 18 days to expiration and I hold on to it until 2 days to expiration, when I go to sell it back to the marketplace, if price is in the same general area, this trade will have gained a lot of value because this front month option, the June 19 that we are going to be selling, we'll be able to buy that back with only 2 days of extrinsic value left in it, which means it will be almost worthless, right? And right now, if we're selling a $3.61 option and we're buying a $3.84 option, what we have to pay to enter this trade is the difference between those two. Now, I'm just going to ballpark this and say that that's around 23 cents. So if we enter this trade for 23 cents and we have to sell it back into the marketplace to exit the trade, if that front option for 361 has no time value left and is almost worthless, then my back expiration option, the one that's for the $3.84, that will be the one carrying the most value in this trade. And so when I go to price it on the marketplace, the value of the trade will be 384 minus however much time has gone by. And that difference between those two strikes, that is what we get to sell it for. So right now, the difference between these two strikes, that's what we have to pay to buy into this, to buy this trade. To exit, we have to pay the difference between those two. All right, or we get to sell it for the difference between those two. So since right now they're only 23 cents apart, that's what we buy it for. But when there's almost no time left, that front one, it will decay so much faster that they won't be 23 cents apart anymore. They'll be a lot farther apart because the back option will not have expired so quickly. So let's kind of point this out about the debit and the trade. So you can see we got the 277 calls, June 24 and June 19. It's a $22 trade. The max profit is shown along the left side here. And I went ahead and put a box around the value. This is where the current price is of the market that we're looking at. And we need to exit this trade by June 19th. You never want to stay in a calendar all the way up until the day of expiration. Right? You don't want to hold it into expiration. Now you can see that this green line right here, this is the actual profit right now in the trade. But as time goes by, this green line will start to form the shape here. And if our price, which is this gold line running, gold dotted line, if our price is within this profit tent, then that is the price that we would make when we go to trade it back to the marketplace. Right? And of course we want to be as close as we can to the 277 because that's where our highest profit potential would be. The max loss in this trade is what we paid for the trade. We can't lose more than we paid for it. All right, so if the absolute worst was to happen, we would lose $22. Now there is a catch. All right, you'll never make this red line in value. That's the first catch. The second of all, this red line, this is going to move. It's going to shift higher or lower depending on the volatility in the marketplace. So if you were to get into a calendar and volatility gets crushed out of the marketplace because of an earnings announcement, then your target profit, this peak way up here close to the $200, it would be way down here, right? And the more volatility that gets crushed out of these options, the lower your max profit could be, right? But if you get into this trade and then volatility expands, then this max profit would go far beyond this $200 and actually grow in value, right? So there's also the idea that price doesn't just need to be inside this tent. It needs to be inside this tent at a very specific point in time. In our case, June 19 is when our front option is going to expire. And within the last 4 days, maybe 5, you would definitely need price within this range. If price was to get into this range sooner than those 4 or 5 days, you wouldn't find any value in the trade. So like right now, this trade, you can see it has no value, right? It's at the zero line because we've got a lot of time between now and June 19. As time goes by and this green line starts to rise, that is our actual profit. So we don't just need to hit the right price. We need to hit the right price at a certain point in time. Too soon and you won't make any money. Too late and you won't make any money. You can see that if you had price movement that went beyond our strikes ranges, then we would be in the negative territory, right? So there's always a balance. A lot of people don't like to trade calendars because they cannot see what their actual profit potential is. And a lot of traders use a very simplistic risk-reward ratio. However, there is a way to ballpark the value in a calendar, and there are many trade plans that involve using a trade with a specific target profit percent. And this I have found to be way more valuable than trying some arbitrary made-up number like oh, I want to make 3 to 1 or I want to make 2 to 1. It'd be a lot better to identify your win rate and match that to a target profit percent. So a calendar spread, it also is called a time spread. The easiest way to picture this strategy in your mind is to recognize what the goal is in this trade. So in this picture, we can visualize the decay in an option that is sold with 4 weeks of time value and an option that is bought with 8 weeks of time value. On the left side of this graph, we have theta value, and on the bottom of this graph, we have time. And so you could see that an option with 8 weeks, if we were to buy this trade in December, in January, this front expiring option would be here, and the February option would be here. All right, so that's the time frame that we could look at. All right. An easy way to identify this when you're looking at this graph is suppose we went 6 weeks and just moved up right here. Where would we be at 6 weeks? We'd be at this value. And what if we were with this February expiration, we would be at this value at 6 weeks. So if I can get the laser pointer going, maybe. Aha! Now you can see my mouse. So if we were just to draw the line here, an imaginary line, at 6 weeks, what would be the value of that January expiration? It'd be around $5. And what would be the value of that February expiration option? It'd be maybe around 7.25, all right, maybe right in there. They might have started out at a value of $6 and $8. But at 5 weeks, for an example, where would the value be? Maybe $3.50, $4, yeah, $3.50. And yet this one would still have quite a bit more value in it, right? If we were at 5 weeks and we just track it up, that would be about right here. It's around $7. So you can see that this option, the January option, it's expiring faster because the decay is steeper. One way to analyze a spread is using strike price shift increment. And yes, that's a mouthful. strike price shift is a way that we can quickly identify the value of an option. If. If. What does that mean, if? It means we look at these values and we ask, what if the price goes up? What if the price goes down? Then we look at the options table and we see what the value is for a higher strike or a lower strike. And that is strike price shift. So here's an example of strike price shift. Okay, if we only looked at the value of the option, if I was to buy a 276 and the market went up $1, what could I sell it back to the marketplace for? I could sell it for $5.34. So I bought it for $4.75 and I sold it for $5.34. Right? And of course we would want to be splitting the difference between these two, right? Slippage. But we use that strike price increment to identify what would happen to the value of our options if the market went up $1, if the market went down $1. We can do the same thing with time value. So in this example, with 32 days, not 34 days, with 32 days to expiration, if I sold an option for $4.68, what would it be worth when there was only 18 days left until expiration? Well, it would be worth $3.61 if the price of this market didn't change. All right, so at 18 days, the 277, it's worth $3.61. The 277 with 23 days to expiration, it's worth $3.84. So we gained around 23 cents here. At 27 days to expiration, that is worth $4.19. At 32 days to expiration, it's worth $4.68. It's the same strike. Nothing has changed in the marketplace except time. There's less time value in this option, and so it's worth less money. If I sold that $4.68 and I bought it back at $3.61, I would make $1.07 in profit. This is a live example of time decay. Now, obviously, this is just based on time value alone, and it does not account for changes in the marketplace. For example, you can see that the at-the-money calls are the 275, 276. If the stock price rises above that or falls below that, the value of these options at 277 will change as well. Another way to recognize that your calendar might be worth after time has passed is to build two different trades. Make one trade your entry and make the other trade your exit. It sounds a little confusing, doesn't it? Here's an example. Suppose I wanted to build a calendar and I make it with 48 days to expiration. What would my trade be worth when there is only 2 days left until expiration? Well, first, I would want to build the trade, and I would take care to recognize the dates until expiration and the days between the strikes that I'm going to use. So in this example, if I'm building a calendar with 48 days until expiration, and I'm using the 277 call strikes, and I make the spread 28 days wide, I want to go and look at the debit for this trade. So I could buy this trade for $1.92. Okay? The difference between these two is 28 days. And the entire trade, we always want to look at the front expiration to identify how long we can be in this trade. So this is a 48-day calendar with a 28-day wide strikes. And I want to keep that in mind when I build my exit trade. Now I've gone and built another trade. I would build the same trade with only 2 days left until I could close the trade. So let's suppose I wanted to exit this trade with 2 days until expiration. I would then go and build the trade again with that expiration in mind. In this example, I built the trade using the June 3 277 calls and the July 1 277 calls. This shows us what the value of the trade would be worth with only 2 days to expiration. If we bought the July-August trade to enter this position at $1.92, and we could sell our position back to the market at 2 days to expiration for a value of $3.77, we could make quite a profit. If you look at this picture, you can see that now we have 2 days to expiration. The trade is 28 days wide. The value has gone up a lot, which is good because we bought it and we would need to sell it back. And what we're just looking for when we build this trade is what is it worth right now, right? And we could just see what is if we was to shop for one of these trades at this time, what's the going rate? Well, the going rate is $3.77. Well, when we built ours, it was $1.92. So after we built it, it gained value through time, and now when we go to sell it back to the marketplace, we'll make quite a bit of profit because we're selling to close. So I'm going to flip back one so you can see these numbers again. All right, so this is where we started at $1.92, 28 days wide, 48 days until expiration, and this is where we ended, 2 days to expiration, 28 days wide, and with a value of $3.77. And this is a way that you can ballpark what your trade would be worth when you are getting ready to exit the trade. All right, and most people don't like to trade calendars because they can't identify how much they could make in the trade. But what they were never taught was strike price increment and being able to just recognize what's the value of your option. What is the value of your option with 28 days, and what is it worth with 2 days? All right. Once you grasp this, your options experience and knowledge is going to put you far ahead of the rest of the marketplace. Right. Max loss and salvage value. It is very rare to take a full loss in a calendar trade because the back expiration option will almost always have time value left in it. Because it still has time value, that means it still has value. So the typical way people lose 100% in a calendar is by not managing the trade early. This is called salvage value. Remember that an option with no time value and out of the money option has no value. However, the option farther out still has time value, and this is our salvage value. The max loss in a trade comes down to what you paid for the trade. Losing in a calendar spread. When trading a calendar, the options at the money have the most time value. So when we go to exit the trade and sell it back to the market, we want the price to be close to our strikes to see the greatest value in the trade. If the price is not close to our strikes, we stand to lose money or make less money in the trade. It does not matter where we choose to enter the trade. We can choose strikes in the money, out of the money, at the money. All of those are okay. What matters is what happens to price as time goes by and where price is at near expiration. Calendars are only profitable over time. So you need price to make the strikes at a certain point in time. Does that sound difficult or what? You think that the only way to be profitable is to get the price of a market months or weeks away and you need it to be at that price at a certain time. If you get to that price too soon, you won't make any money. If you get to that price too late, you won't make any money. But that's only part of the equation. Placing a calendar spread is not just a trade based on price. We don't build them with only hoping to hit a certain strike. This isn't target practice. Placing a calendar spread can be done because of volatility. If you enter into a calendar with low volatility and the volatility rises, the value of your options will increase and the window to be profitable will expand. This is one of those options trades that actually can become more profitable than what the max profit showed when you entered the trade. Break even cannot be calculated, but it can be estimated. Remember, strike price shift. Max profit, max value cannot be calculated, but it can be estimated. Remember that volatility can increase the max profit in this trade, so the broker cannot calculate the max profit like it would with a credit spread or a debit spread. However, we can calculate a target profit percent, and this is way more valuable anyways, and it provides actionable material that we can use to take the trade. We don't need to know what the max profit in the trade is. We only need to know, can we hit our target profit? Because we're only going to hold it long enough to hit our goal, and then we're going to exit the trade. Remember, we'll never hold these to expiration, so we will never, ever get the max profit in this trade, and that's not the goal. Understanding value, you got to recognize where price is at, where price will be later, and can price reach your strikes that you are going to choose. Understanding the value in your calendar comes from understanding what your options value will be in the future. From that understanding, we can plot price in the future and determine an estimate of what the trade would be worth when we attempt to sell it back to the market. If the market goes up $1, what are your options worth? If the price goes down $1, what are your options worth? At 15 days to expiration, what are your options worth? You can see we really can begin to dial in and understand the options value. Okay, so calendars are not some mythical creature that we'll never be able to figure out their value. Of course, we can get a very strong estimate. Now, choosing puts and calls. This doesn't have to be complicated at all, right? If the price of the market is at $300 and you want to put on a calendar at $280, you would use puts because your target is below the current price of the market. If the market's at $300 and you want to put a calendar on at $320, then you would use calls because your target is above the current price. All right, so now that we've gone through all the boring stuff, let's jump on over into Thinkorswim and kind of build a few examples. So earlier, I showed you pictures of two different strikes, of two different calendars. I still have both of those built. Now, this top trade here, this top calendar, this is the July-August trade. All right, this was the trade with 40-something days to expiration. All right, so we can just scroll down here, take a look at 48 days to expiration. And if we bought it for $1.92, before we buy it, if we came in and looked at it on the Analyze tab, we would be looking at something like this. And this is showing us that we could get a value somewhere near $300. Now we know from discussing this earlier that we would never actually hit this max value. But we also know that as time goes by and volatility rises or falls, the value of this can actually expand or contract. So if I was getting in this trade at $1.92 and I could see, I could make around $300. If I took the trade right now and time went by and it was 2 days to expiration, what would my trade be worth? It would be worth this price, $3.77. Now, don't let this shift you around and get you confused. This is only our way of looking at what the value of the trade is worth. I know it says debit, and I know it's green, and it looks like we're trying to buy this, right? But don't let that get you confused. We need to identify that this is the trade we are looking to get into, and it's got 40 days in it, and our strikes are 28 days apart, a 48-day trade. And all we want to know is, if I buy it right now and time decays, what could I sell it back to the marketplace for when there's only 2 days left until expiration? It would be worth this much. So forget the idea that it says debit here. Just recognize that I'm buying it for $1.92 and I'm going to sell it for $3.77, all else being equal. And what I mean by that is all else being equal, as long as the marketplace stayed in the boundaries that we are at right now, right? Because this is showing us what the value of this option would be worth 2 days to expiration if price didn't move. And of course we know price is going to move, right? Now, if you're having a difficult time understanding how this gained in value, let's go over and take a look at the trade. So when I built this June-July trade, oh, that's the front one. So let's build our original trade here. Sell that one, and we want to buy this one. So the one that we sold here, it's $5.59. And we bought one that's $7.57. The difference between these two is the debit that we're going to pay. Okay, if I was just to bring up a calculator and take 757 minus 559, I'd get $1.92. So now I know that's how we came up with this price for how much the trade is worth. Well, the really great thing about trading two different expirations is that when something gets very, very close to expiration, it has almost no value left in it. You can see that here we are, 2 days to expiration, and that 277 call, it's worth 75 cents. But this call here, the 277, with 30 days to expiration, this one still has a lot of extrinsic value, right? It's worth $4.53. Well, remember how we got that debit before. We took the expiration here and subtracted this expiration from it. So if I was to take here the 453 and subtract 75 cents, that's what our trade would be worth that close to expiration. All right, so you can see if I just go in here and throw it together, there's our 377. The reason that this trade gained value is because this front expiring option lost value faster than the back one did. And remember, the difference between these two is what the trade is worth. So way back here, when they were both very expensive, it didn't cost us a lot to get into the trade, right? The July and the August, these are both very expensive options. And the difference between them was that $1.92. Let's get this put together correctly. All right, so that's where that $1.92 came from. It's just the difference between these two options. But as this front one expires faster and faster and faster, the distance between them is going to get wider and wider, and that is going to increase the value of the trade. That's it. It's that simple. That's calendars in a nutshell. Now, choosing different strikes, developing trade strategies, manipulating the trade based on volatility, all of these things are different parts of the puzzle that actually go into developing a calendar strategy, right? But this video was specifically developed just to kind of help you get a grip and an understanding of how calendars really work, right? And I appreciate you watching this video, and I look forward to seeing you at the next one.